concept is being discussed in the conceptual framework of financial reporting. So the first thing we should discuss is about the capital. What is capital? There are two possible concepts of capital. Number one, financial concept. And the other one is physical concept. What is financial concept of capital? Actually, basically, capital relates to the net assets, or we can say the equity of the company. This is the most usable concept in the industry, and most of the entities preparing their financial statement on the basis of their financial capital. In the financial capital, there are two types, you can say. The monetary terms, if we write it as monetary terms in dollar, in rupees, and mostly companies apply this concept and gives their financial statements in the monetary terms. The other financial concept of capital is in the units of constant purchasing power. Constant purchasing power. This is basically majorly used for the capital maintenance concept, which we will discuss with the example after some time. What is physical concept of capital? If the capital is regarded as the productive capacity, then this is called the physical concept. For example, what is productive capacity and how this can be shown? For example, we can say 200 units of output per week or per day or per month or per year. We use this monetary terms capital. Now we will discuss the concept of capital maintenance in detail. As per financial concept, the financial value of equity at the end of the period exceeds the financial value of equity at the beginning of the period. After adjusting for equity, capital raise or distribution is the dividend. Normally we use historical accounting in the financial concept of capital maintenance. Money financial capital maintenance. The other one is in the financial concept we discussed as for the constant purchasing power. Whereas the physical concept of capital is that the capital of the entity is represented by its productive capacity or operating capability. Where a physical concept of capital is used, the main concern of users of the financial statement is with maintenance of operating capability of the entity. We will discuss this with the example, which is question number 1. On 31st December 17, Kangri Limited has equity of 500,050. This is at the beginning. Next year on 1st January it purchased 250 units. From this equity that has been invested in the company, it purchased 250 units at the rate of 200 per units to be sold afterwards. During the year 250 units, the all units were sold for 2200. Inflation, general inflation 3%, and specific to these units, say if the business is of clothes, then the specific to the clothes inflation is 7%, but in overall the industry, in overall the country, the inflation rate is 3%. So we have to maintain capital. What amount should be available at year end, what amount of dividend may be given, and what amount of transfer to inflation reserve. What is inflation reserve? We will discuss. In each of these concepts should be discussed in financial capital maintenance, the money terms. Financial capital maintenance real terms is relates with purchasing power, where purchasing power came, it is regarded as a real term. In reality, we have to include some inflation also, but whenever the financial capital real terms or purchasing power came, we use general inflation. But in physical capital maintenance, we use specific inflation. Why? We will discuss after some time with this example. So here are the example which I have read it out. Our opening equity is 500,050. For example, what is an equity? There could be a share capital, there could be share premium, there could be a retained earning, and so on, revaluation surplus, etc. and etc. And the total at the beginning is this. So first of all, we will discuss capital maintenance money terms. It is historical based counting. Historical. This is financial capital maintenance. We used to write the sale as 250 units into 2200. 250 into 2200, 550 came. Cost of sales, opening stock, there is no opening stock. We have purchased 250 units at the rate of 2000, comes at 500,000. Our total cost of sales comes at 500,000. So the GP sales less cost of sales is equal to 50,000. Some expenses, no expense, and our net profit comes at 50,000. So if I use equity as a T account and make an opening for it, our profit after tax would be 50,000. If I have to only maintain my CD should be equal to this BD, but in financial terms, means in rupees, this rupee is 500,050. I have to maintain this over here also. So what I can give to the shareholders, I can give dividend payable as balancing figure, which comes as 50,000. I can give dividend 50,000 which is earned. This is monetary terms, which is most easy. Let's discuss what is financial capital maintenance real terms. in real terms, and we use general inflation in it. Why we use general inflation we will discuss right now. Just like the T account of equity, I will make a T count of equity over here. Financial capital maintenance real terms. Here BD is 5,000,050. To maintain this, I need now, what I do need, I need some more value. Reason, we will not been able to purchase the same amount of things after 1 year. After 1 year, this amount will not be able to purchase the same things as we purchase today, as we purchase this year. So we have to maintain our capital, our equity, our net assets, and add something, inflation effect. Inflation effect is 3%. I will multiply my opening into 1.03 to increase the value. It comes as 515,052. To maintain my net asset, my equity, I have to adjust my closing balance with the inflation effect. So what should I do? I should transfer from my profit some amount in the inflation reserve. In equity, another thing came as inflation reserve. I made this statement of changes in equity for you. I will show you in the T account form. We have earned the profit 50,000, but we will transfer less. Transfer to inflation reserve. Now, how to calculate this inflation reserve? We will calculate inflation reserve on the base of our opening capital, 5,000,050 into 3%. 5,000,050 into 0.03, 15,002. Will transfer 15,002 from our profit to the inflation reserve. We can say we have earned profit after tax as 50,000. Then we transfer it to inflation reserve. In other terms, this is the reality. We should do like this. But so I have earned 50,000, but at the right time I have to transfer it some amount to the equity. It should remain in the equity 515052. So I can give dividend payable as amount 3499 as I have transferred some amount to inflation reserve to the equity. So the equity increase the value with the general inflation rate. Like this, if I see what is my total equity, this will 350, this will 50, this comes as over here dividend 34998. my balance will remain 100050, but something added as 15002. my opening was 500050 and my closing would be 515052. 3,50,000, 50,000, 100,050, and this comes as a new head inflation reserves 15002. If we will move forward to the physical capital maintenance. In the physical capital maintenance, we use a specific inflation rate. In physical capital maintenance, reason, let's discuss it with the T account. Equity, physical capital maintenance, and over here specific inflation will be applied. BD 500050. Now to maintain my equity, I have to increase this amount. Reason, I cannot produce the same amount of things with this amount, or I cannot buy the same number of products from this equity which I have at the start. Reason, in general, wherever the financial capital maintenance, we used to see the money and we used to see it with general inflation. What is an increase generally in the country? But you have seen there are different things having different inflation rates. So if clothes have 7% inflation, but the overall general inflation is only 3%, should we apply 7% to maintain it, or should we apply the 3%, the general inflation? To maintain our productive capacity, we have to apply the specific inflation rate. So we apply 5,000,050 multiply by 1.07, and to maintain our equity, our purchasing power, our productive capacity, we need to have 535,054 at the end of the year, so that we can produce the same amount of things in next year. We have earned 50,000. Our profit after tax is 50,000, but we apply inflation reserve 5,005 into 7% specific inflation, which comes at 35,004. So this could be our dividend we can give to our shareholders. Dividend payable, retained earning debit, dividend payable credit 14,996. We can give 14,996 to our shareholder, so that at the end of the year we may have this amount of equity to maintain our productive capacity. Now we see it in a summarized way in a notes form. We do have two financial capital maintenance and physical capital maintenance. Closing equity's value should be greater than the opening equity value. We have two terms under it. One is money financial capital, second is real financial capital. Equity is maintained increased by using general inflation rate. Purpose, what is purpose? Purpose is maintain or same purchasing power. So we can write as a profit and loss or retained earning debit and inflation reserves credit. And historical accounting is being used in the money financial capital maintenance, and general inflation effect came in real financial capital maintenance. Normally our investor used to see financial capital maintenance because the statement of financial positions normally gives this historical accounting. Under the physical capital maintenance, normally management used to see what productive capacity we should have for the next year. Closing equity, our capacity should be greater than opening equity, our capacity to buy or capacity to produce. Equity is maintained, increased or increased by using specific inflation. Purpose or maintain same operating capacity. What is the logic behind is this? We have to maintain the concept of current cost. We use specific inflation, and normally management and employees used to see physical capital maintenance. Thank you very much. This is our concept of capital and capital maintenance, and best of luck in your studies.